We are about to start in this room, concurrent research paper session 1, titled Paycheck Protection Program Lending. Greg Udell, who I was just speaking with, is the moderator for this session, and our community bank discussant, David Krause, CEO of Pioneer Bank in Mankato, Minnesota. We will introduce the researchers in a few moments. But to ask a question, once we get to that segment, you can hover over your name, and if you do that, there's a raise hand button. If you click on that, our production team will actually see that in the order that the hand was raised, and then you can ask a question in either the chat or Q&A. We will just we will see that. And we'll do our best to get to your question. I will note we're a little bit tight on time, which is why we've also, for our registered guests to the webinar, added these virtual receptions at the end of each day, and we're going to actually have 2 separate ones. So room A will be, and we'll provide links to that, will be for a research discussion. So we'll have an hour to continue this conversation, and then room B will be to discuss the 2021 National Survey of Community Banks. So here we are, research paper session 1, Paycheck Protection Program Lending, and it gives me great pleasure to introduce our academic moderator for this session, and you should be able to see him on your screen. Greg Udell is the Chase Chair of Banking and Finance at the Kelley School of Business at Indiana University. Professor Udell has nearly 100 publications, mostly focused on financial contracting, credit availability, and financial intermediation. So Greg, I'll turn it over to you to say a few words and offer a few thoughts before we turn it over to our first paper presenter.
Thanks very much, Jim. We've got a really interesting session here, and actually I think Governor Bowman really did a good job of setting it up. So why don't we turn right away to the first of the 2 papers, and I think, Padma, you're going to present your paper. So I'll just turn it over to you in the interest of time.
Good afternoon. I'd like to thank the organizers for selecting our paper into the program. We appreciate this unique opportunity to gain perspectives from bankers, academicians, regulators, and supervisors on our research. This is joint work with my colleague Blake Marsh from the Kansas City Fed. The usual disclaimer applies. The views in this presentation are our own, not of the Federal Reserve Bank of Kansas City or the Federal Reserve System. In this paper, we study the effects of government loan guarantees in a crisis on bank outcomes by examining the lessons from the Paycheck Protection Program. The main motivation for studying the PPP is its unprecedented scale and scope, which had over $950 billion appropriated under the program, of which $808 billion were used to issue new loans to small businesses. Another aspect of the program that sets it apart from typical crisis time interventions is that it relied on private capital to issue the loans initially, which were ultimately guaranteed with a federal backstop. Not only was the program designed to be large in scope, it also elicited widespread participation by both firms and banks. Indeed, the PPP accounted for nearly all new lending in 2020, as we can see in the chart on the left. The blue bars here represent total growth in total PPP C&I lending, and the green bars represent growth in C&I lending after excluding PPP loans for 3 groups of banks: those with high and low exposure to PPP and non-participants. The difference between the blue and green bars and the limited lending growth among non-participants suggests that the PPP overwhelmingly contributed to new C&I lending growth last year. In our paper, we focus on participation and outcomes of community banks. As has been widely known at this point, their participation was outsized relative to their market share. Even though community banks hold only 18% of banking industry assets, they disbursed 37% of PPP loans. The widespread participation in the PPP and its unprecedented size led us to these research questions. What drove community banks to participate? Were they constrained by funding capacity, or were they driven by a preference to preserve capital? What determined the intensity of participation? Was profitability the driving factor, or was it risk aversion? We are also interested in studying the spillover effects to bank lending. For instance, did the PPP crowd out private capital? Did it induce risk-taking? Here is a preview of the results before I move into details of the methodology. Participating community banks were larger and more profitable, indicating the importance of funding capacity in being able to participate in the program. But participating community banks were also relatively less capitalized, suggesting that banks likely viewed the program as a way of transferring risks from their balance sheet to the federal government's balance sheet. When we move on to PPP originations, or what we refer to as intensity, we find that it increased with size and liquidity, again underscoring the importance of funding capacity in being able to originate PPP loans. But it also increased with C&I exposure, likely pointing to a channel of risk aversion for participating in the program, in that banks that were more exposed to potential loan losses from business loans were also more likely to participate in the program. We also find that banks responded to pandemic-induced firm demand to PPP loans, as is clear from increased originations associated with increased COVID-affected employment share in a bank's region of operation. PPP reduced profitability, but it offset a credit crunch. Our results suggest that in the absence of the PPP, we would have likely seen a decline in C&I lending, the way we saw in CLD lending and C&I lending during the global financial crisis. I will briefly go over a couple of parameters of the PPP that are relevant to the bank outcomes that we study in our paper. The PPP required banks to have access to cheap and stable funding sources, since loans on this program only carried an interest rate of 1%, and fees were recognized over the life of the loan or upon forgiveness rather than as a lump sum at origination. The low interest rates and gradual recognition of fees likely weighed on bank margins, at least initially. The program also likely required banks to have sufficient capital buffer space, since these loans weighed on bank leverage ratios, even though PPP loans carried a zero weight in risk-based capital measures. The PPP liquidity facility was a way to provided a way to ease both of these burdens. It provided low-cost loans to banks, and these loans were collateralized against PPP loans. Moreover, banks were allowed to exclude PPP loans from their calculation of leverage ratios when they borrowed from this facility. To systematically study the effects of the program on bank outcomes, we start off by considering all the key decisions that banks need to make with regards to the program. First, they decide whether or not to participate in the program, and conditional upon participation, they determine the level of PPP intensity, the intensity with which they participate, which we calculate as the share of PPP loans to total loans. We evaluate outcomes across both groups of banks, participants and non-participants, while especially focusing on the effects of PPP intensity on outcomes of participants. While evaluating the effect of PPP intensity on bank outcomes, we are interested in evaluating the effects of those loans that were originated on account of pandemic-induced demand for these loans by firms. To measure this demand, we developed a measure based on COVID-affected employment in a bank's local market, which is then weighted by the deposit share in that local market. This represents employment in sectors that were adversely affected by restrictions on economic activity. So this is essentially employment in sectors such as entertainment, retail, hospitality, restaurants, all in the region in which a bank operates. We study bank outcomes related to profitability, namely NIM and change in NIM from 2019. Growth in bank loans, particularly growth in C&I loans, both overall as well as outside of the PPP. And finally, we evaluate risk-taking by considering growth in CRE loans. Funding capacity and risk aversion determined PPP take-up. We find that larger, more liquid, and more profitable banks were more likely to participate and to participate with greater intensity. This suggests the importance of funding capacity in being able to participate and originate PPP loans. Moreover, we find that banks with lower tier 1 leverage ratios and greater exposure to CNI loans were also more likely to participate, likely revealing a risk neutralizing and risk aversion channel to participating in and originating PPP loans. We also find that banks responded to pandemic-induced firm demand of PPP loans as measured by COVID-affected employment share in a bank's region of operation. Overall, the PPP expanded lending but compressed margins. In this table, the first row represents the estimated effects of the PPP on 4 different bank outcomes for the average bank. And here by average bank, we mean one which has a ratio of PPP loans to total loans of 8.5%. The second row represents our uncertainty in these estimates. The estimate in the first row lies within the bounds, within the square brackets in the second row with a probability of 95%. For the average bank, we find that the PPP resulted in a decline of NIMs of 37 basis points and a substantial growth in CNI loans of 87% on a year-over-year basis. The effect of the program on PPP on CNI loans outside of the PPP was moderate at 8.7%. Overall, the PPP did not have a sizable effect on CRE growth, as the probability bounds of this estimate lie on either side of 0. So we conclude that the PPP did not have a notable effect on bank risk-taking. We make use of our estimates to ask a broader question, namely, would banks have continued lending to firms in the absence of the PPP during the pandemic? And the answer is no. As we can see in this chart here, the blue and the green lines respectively represent average CNI lending growth among participants and non-participants. And the yellow line represents the estimated growth in CNI lending for participants had they chosen not to participate in the program. Our main conclusion is that we would have likely seen a large contraction in CNI lending if participants had not participated in the PPP, since the entire distribution lies to the left of 0. This is consistent with what we have seen in previous crises, including the decline in CLD and CNI loans during the global financial crisis, as well as across a category of various categories of consumer and business loans during the New England credit crunch. In conclusion, banks were driven by risk aversion rather than profitability to engage in the Paycheck Protection Program. Banks likely viewed the program as a source of protecting existing loans and as a source of revenue during economic uncertainty. The full guarantee offered by the program was likely an important parameter in eliciting widespread participation across both banks and firms. Pre-pandemic balance sheet characteristics determined participation. We saw that larger, more liquid, and profitable banks participated and with greater intensity. Finally, the PPP averted a credit crunch. Therefore, it likely serves as an effective fiscal policy measure in the event of future crises, but net benefits depend on the state of the banking industry and source of economic shock. For instance, an equivalent program during the global financial crisis would have likely been less effective, since the shock itself emanated from within the financial sector and bank balance sheets were weaker back then. But in response to an exogenous shock like the COVID-19 pandemic, the PPP, which was designed to support small businesses, we find also indirectly supported small banks themselves. With that, I conclude, and I thank you for your time.
Padma, thanks very much.